Good morning, good afternoon, good evening. My name is Market Maker 69420. In this episode, we're going to talk about the market close and how it affects the economy. As markets wrap up on Friday, March 13th, 2026, geopolitical tension in the Middle East casts a long shadow, driving sharp volatility across asset classes. Stocks ended lower amid renewed inflation fears from surging oil prices, while commodities saw dramatic swings, with energy leading the chart. Cryptocurrencies mirrored the risk-off mode, pulling back slightly but showing resilience through ETF inflow. This close underscores how external shocks are rippling through interconnected markets, potentially setting the stage for a cautious weekend hold. All right, let's get into the stock market. The U.S. stock market concluded Friday with notable declines, reflecting investor unease over escalating Middle East conflicts and their implications for energy prices and inflation. The S&P 500 fell 1.52% to close at 6,672.62 cents. The Dow Jones Industrial Average dropped 1.56%, 739 points, to $46,677.85, and the Nasdaq Composite slid 1.78% to 22,311.98 cents. This downward direction came after an initial attempt to recover from Thursday's steep sell-off, but sellers dominated as the session progressed, erasing earlier gains. Volume and liquidity were robust, with total consolidation volume reaching approximately 3.36 billion shares, though matched volume across major exchanges like New York Stock Exchange and Nasdaq showed a slight dip compared to the 5-day average. Liquidity remained adequate but thinned in after-hours trading, contributing to choppier price action as participants positioned for weekend risk. Today was not a major options expiration day, as standard quarterly expirations typically fall on the third Friday of the month, March 20th in this case. However, pinning effects were evident near key strike levels, particularly in energy and tech sectors, where implied volatility from options pricing influenced spot prices. The absence of the triple witching event meant less forced rebalancing, but ongoing geopolitical news amplified intraday swings. Sectoral rotation was pronounced, with energy stocks outperforming amid the oil rally. Gains in companies like those tied to crude oil production helped offset broader losses. Defensive sector like utilities and consumer staples saw inflows, while growth-oriented tech and semiconductors faced heavy selling pressure, dragging the Nasdaq lower. Market breadth was negative, with decliners outpacing advancers by a 3-to-1 ratio on the New York Stock Exchange, indicating widespread caution rather than isolated weakness. The CBOE Volatility Index, VIX, often called Wall Street's fear gauge, climbed 2.82 points to 27.05, marking its highest level in nearly a year and reflecting heightened uncertainty. This spike aligned with historical patterns where VIX surged above 25, signaling short-term market bottom, but sustained levels could pressure equities further if tensions persist. After-hours futures pointed to a mixed open for Monday, with S&P 500 futures initially up 0.2% before easing, while pre-market indicators like bond yield, 10-year treasury at 4.23% suggest lingering inflation worry. Energy futures remained elevated, potentially supporting a rebound in related stocks. News flow was dominated by geopolitical developments, including U.S. Navy escorts for tankers through the Strait of Hormuz and ongoing strikes involving Iran, which fueled a perfect storm of fear over supply chains. Corporate earnings such as strong AI-led result from Marvel Technologies, providing some counterbalance but couldn't stem the tide. No major economic data release occurred today, but anticipation built for next week's PPI and consumer sentiment figure. In broader economic and technical context, the stock appear oversold on RSI indicators, with the S&P 500 testing support near its 50-day moving average. The market's resilience in shaking off initial jitters suggests underlying strength in corporate fundamentals, but prolonged oil spikes could delay Fed rate cuts, weighing on multiples. This close amplifies risk to the ongoing bull market, particularly if inflation reaccelerates. Let's move on to the commodities market. Commodities settled with stark contrasts on Friday as energy prices soared while precious metals retreated amid the Middle East escalation. Brent crude oil jumped 10% to $101.21 per barrel, while WTI crude rose around 96.33, up 0.64% intraday, but reflecting broader week gain. Gold fell 1.8% to $5,084.80 per ounce, and silver dropped 1.96% to $83.77, reversing some safe haven gains. Position management leaned conservative heading into the weekend, with traders reducing long exposure in metals to hedge against potential de-escalation or profit taking. Weekend risks premium were evident in energy, where fears of Strait of Hormuz disruptions prompted some to square positions rather than hold open. Liquidity thinned in after-hours sessions, but volatility patterns were extreme. Oil's day range exceeded 10%, driven by intraday highs near $119 before a pullback. This mirrors 2022's energy shock, with implied volatility in crude futures spiking to multi-year high. Open interest in oil contracts surged, with platforms like Hyperliquid reporting over 2.5 billion in volume since Friday's close, indicating heavy rollover activity in front-month contracts. Precious metals saw more subtle interest, with COMEX gold volume at 109,497 lot. Macro news flow centered on Iran conflict, with tanker explosions and production halts in Qatar and Saudi Arabia, amplifying supply fears. Fundamental drivers included IEA reserve releases, which failed to cap price, echoing mixed outcomes from past interventions. Technically, oil breached key resistance at $100 with order books showing clustered buys stops above 103. Support held at $90. Gold tested 5,021 intraday lows before stabilizing with 4,950 as potential downside if yield rises further. Broader sentiment is bearish for growth-sensitive commodities, but bullish for energy, with the market pricing in a prolonged conflict that could push oil towards 110 to 120 if disputes worsen. Now let's look at the cryptocurrency market. The cryptocurrency market exhibited muted decline on Friday, tracking equities amid the oil-driven risk-off environment. Bitcoin dipped 0.6% to around 70,319, while Ethereum held steadier but still faced pressure, trading near 2,044 after a volatile week. Total market cap hovered around 2.38 trillion, up slightly intraday but flat overall. Liquidity levels remain healthy, with decentralized platforms like Hyperliquid seeing 1.5 billion in daily oil-related trading volume, spilling over to boost crypto liquidity indirectly. Volatility was elevated, with Bitcoin's monthly gauge nearing double to 61%, and the asset's correlation to stocks surging. Price swings included a 3.5% drop tied to Iran headlines, but Bitcoin recovered above 69,000 by close. Trading volume trends showed strength, with 619 million in global crypto funds inflows last week, including 521 million into Bitcoin's ETF. Institutional activity ramped up, with entities like Strategy adding 17,994 Bitcoin to their reserves. News and rumors focused on geopolitical ties, with oil spikes seen as bearish for Bitcoin due to miners, costs, and inflation risks. External events like ETF outflows and Ethereum highlighted a demand gap versus Bitcoin. Correlation with broader markets intensified, with Bitcoin moving in tandem with stocks positively, but inversely to oil amid stagnation fears. Macro factors, including Fed policy and bond yields, are increasingly dictating direction. Risk management consideration emphasizes hedging against weekend gap, with Bitcoin's 50-day moving average at 73,000 as key breakout level. Stabilizing above 70,000 could signal a rebound, but prolonged tension risk deepen downturns. In summary, Friday's close highlights the profound interconnectedness of global markets, where Middle East geopolitical strife propelled oil higher, pressuring stocks and crypto through inflation channels while boosting commodities energy. Stocks face headwinds from elevated VIX and sector imbalances. Commodities grapple with supply volatility, and crypto contend with correlated risk evasion despite inflows. Overall, this setup amplifies weekend holding risks, with potential for relief if the escalation occurs, but sustained tension could erode 2026 gains across the board. That's all I got for you guys today. Don't forget to like, comment, and subscribe if you enjoyed the content. And if you'd like to support the content, you can always buy me a coffee on Patreon. Thank you. Bye-bye.